Welcome everyone, and thank you for joining us for today's presentation, Savvy IRA Planning for Baby Boomers. You know, a lot of people have a plan for accumulating money for retirement, but far too often that's where the planning stops, and that's not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement accounts, is just important, if not more so. So when it comes to your IRAs and other retirement accounts, well, you probably have a lot of questions like, how much are my withdrawals taxed? When do I need to beginning to take out withdrawals? And how much will I have to take? What happens to my IRA when I pass away? And perhaps most importantly, how can I minimize my taxes so I can spend more of my hard-earned money? Well, we're going to discuss each of those questions today, but before we get to that, how about a quick introduction? My name is Bill Bush. I'm one of the advisors here at Horizon Financial Group, and at Horizon, we do holistic financial planning and wealth management for individual clients. We are also the advisors on some 75 company retirement plans, most of those 401k plans. That CRPS you see there stands for Chartered Retirement Plan Specialist, and the CPFA, that means Certified Plan Fiduciary Advisor. But today, I'm going to be your guide as we navigate through the IRA landscape. So now that you know a little bit about me, let's talk about some savvy IRA planning strategies. You know, years ago, life was simpler in many ways, and retirement was really no different. Many people went to work, and then when they retired, they collected a pension and Social Security benefits. There wasn't as much needed in the way of planning, and people really weren't all that concerned about running out of money since both pensions and Social Security benefits were generally guaranteed. They were streams of income. For most people, that along with whatever else they had managed to save along the way, that was enough. Today, though, things are different. You know, companies and other organizations, they've abandoned pensions in mass numbers, and instead they've turned to 401ks and similar plans, shifting many of the risks they once shouldered onto the backs of their employees and their families. So retirees now, they're responsible for making more of the critical decisions that will determine how successful they are in retirement. And that includes keeping up with all the changes to the laws that, quite frankly, happen all the time. There's some being discussed right now on Capitol Hill. But the most recent one, just at the end of 2019, the Setting Every Community Up for Retirement Enhancement Act, that's a mouthful, known as the Secure Act for short, made a number of significant changes to the rules for retirement accounts, many of which we're going to talk about today. And the bottom line to all of this, though, is that today, more than ever, when it comes to your retirement, you're kind of on your own. And on top of that, your retirement savings may have to last you a lot longer than you think. According to a 2011 Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 years or more. So let's take a look at this chart here. If you're a man that's age 65, you have a pretty good chance of living to at least 85. Look at the 85 line. Males have over a 53% chance of reaching 85. That's a 65-year-old male today. If you're a woman and you're 65, you have a better chance of living past 85 than dying before it. You see 64% make it to 85. And if you're married and both you and your spouse are 65, then there's a strong chance that at least one of you will live to be 90. Yeah, you see the survivor, 62% chance one of you lives to be 90. In fact, there's about a 33% chance that at least one of you will live to be 95. That means your retirement savings could easily have to last you 20, 25, 30 years, or maybe even longer. Now, that's probably much longer than a lot of you have considered, but all of this together, and you take it, and it makes for having a plan that much more important, really. So with that in mind, one of the best things that you can do as you approach retirement, if you're not already there, is to beef up your retirement savings by contributing as much as possible to tax-favored retirement accounts. Although contributing at younger ages is certainly more powerful because it gives you, your contributions more time to compound over time, You may have been able to save as much as you wanted to, because of these factors you see here. Maybe you were bogged down by mortgage payments or saving for your child's education or other expenses associated with raising a family. Chances are you no longer have those expenses, or they'll be ending soon. And as a result, you may finally have discretionary income that can be used to fund your retirement accounts. So just how much can you contribute? Let's take a look at that. Well, it really depends on the type of retirement account, as well as a number of other factors. But let's begin with traditional IRAs. So a traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside that IRA, it grows tax deferred. Ultimately, when you take the money out of your IRA, the amount that you take is generally added to your income. And we'll talk about that a little bit more later. So in 2021, the maximum you can contribute to a traditional IRA is $6,000. If you're over 50 or older by the end of the year, like many of us are, then you're allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to an IRA for 2021 is $7,000 if you've turned 50 or older. By the way, just last week, the IRS came out with the guidelines for next year, and those numbers are unchanged. So for 2022, IRA 6,000 with catch-up 7,000, 50 plus. Now, you can't always make a traditional IRA contribution, though. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. For most people, compensation is really earned income, but it also could include a number of other types of income. Well, things like, taxable alimony, but it does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. So most of the time, if neither you nor your spouse work, you won't be able to make a traditional IRA contribution. In the past, age was also a barrier that did prevent many people from contributing and making traditional IRA contributions. As such, contributions, really, they were prohibited once an individual reached the year they turned 70 and a half years old. However, the Secure Act, that law we mentioned earlier, passed in 2019, it eliminated that restriction. So as a result, if you have compensation, you can make a traditional IRA contribution, period. The age requirement or that age limit is gone. And traditional IRA contributions, they are deductible unless you or your spouse are active participants in an employee-sponsored retirement plan and your income exceeds a certain applicable threshold. Those limits depend on your filing status and who is contributing to the employer-sponsored plan. So keep that in mind. But many of you probably know that there's another type of IRA called the Roth IRA. Roth IRAs, similar to traditional IRAs in many ways, but there are also some very key differences. And one of those differences is that you don't get a tax deduction when you make a Roth IRA contribution. Once your money is in a Roth IRA, it grows tax deferred like it does in a traditional IRA. The big benefit, though, of the Roth IRA, and another key difference between it and the traditional IRA, is that Roth distributions, those Roth IRA distributions, can be tax-free in retirement. You can pull that money out tax-free. If you had any Roth IRA for more than 5 years and you're over 59 and a half, then all withdrawals from any of your Roth IRAs will be tax and penalty-free as part of what's known as a qualified distribution. Even if you need to take a withdrawal sooner, you can always take out your Roth IRA contributions, what you put in, tax and penalty-free. So some of the same contribution rules that apply to traditional IRAs also apply to Roth contributions. For instance, same $6,000 contribution limit applies. Similarly, If you're 50 or older by the end of the year, that catch-up contribution increases the limit to $7,000 thanks to that $1,000 50 plus. Roth IRA contributions are also subject to the same compensation rules as traditional IRA contributions. So typically you have to have earned income. If you have sufficient compensation, then the only thing that would prevent you from making a Roth IRA contribution is really if you have too much income. So here you can see that some of the limits there, note that if you're a single filer, the income and your income is under $125,000, you can make a Roth contribution. Similarly, if you're married and filing jointly, as long as it's under 198, your income is under 198,000, you can make a full Roth IRA contribution. And then the amount you can contribute after you make 198 scales down pretty quickly. And after 208, you can no longer make any type of Roth contribution. So while some baby boomer couples retire at the same time, we do find that often one spouse retires before the other. So in that case, you may be able to take advantage of spousal IRA or Roth IRA contributions. These are special contributions that allow a spouse with compensation to make a contribution to the traditional IRA or Roth IRA of a non-working spouse. In other words, the non-working spouse can effectively use the working spouse's compensation as their own. The spouse for whom the contribution is being made, however, still must meet all the other contribution rules applicable to the certain type of IRA. Now, you may be thinking, well, gosh, can $7,000 contribution really make a difference when it comes to my retirement? And the answer is absolutely. And here's a quick example. Suppose you're 55 years old now and you plan to retire in 10 years at 65. The kids have flown the coop and you finally have a chance to focus on saving for retirement. So you make that full $7,000 Roth IRA contribution annually for those 10 years until you retire. And if, say, you earn 6% per year, and then by the time you retire in 10 years, look at this, you'd have close to $100,000. But remember, like we said, people are living longer. You may need to plan on living until you're 90 or 95 or longer. So let's say that you leave that account alone and don't put anything else into it, and it continues to earn 6% per year. By the time you reach 85, even if you haven't put in another dollar after the first 10 years, you'd have nearly $300,000. So plus, since you made your contributions to a Roth IRA, that entire amount would be tax-free. So if you still think $7,000 a year can't make a difference, you might, think again. And just think, if you're married and you were able to make that $7,000 contribution to both your Roth IRA and a spouse's Roth IRA, you'd really have twice the amount, and it would be tax-free when you took it out. All right, if you're still working and you have access to one or more plans through your current employer, you might be able to even do better. So while the limits on contributions can vary, certainly from the type of plan that your employer offers, you can generally contribute more to a company retirement plan than you can to an IRA. For example, in 2021, you can contribute up to $19,500 of your salary into a 401k, a 403b, or a similar plan. If you're 50 or older, by the end of the year, you could contribute an additional $6,500 as that 50 plus catch-up contribution. So you add those totals, that would be a total contribution of $26,000 for someone 50 and older. That's how much they could contribute to a 401k type plan. Now, depending on your plan's provisions, you may also be eligible to receive, employer contributions into that, such as a company match, or a profit sharing contribution. So as you can imagine, putting this type of money away for even just a few years can have a pretty good impact on your retirement savings. Plus, provided you meet some of the requirements we talked about earlier, you can make a contribution to your IRA or maybe even your Roth IRA on top of your company's plan contribution. So there you go. Of course, at some point you're likely to retire. And when you do, you'll be faced with one of your first major retirement decisions, what to do with the money accumulated in your employer-sponsored retirement plan. You know, in many cases, people choose to roll their funds over to a traditional IRA or a Roth IRA because they tend to offer greater control over one's retirement funds. They're not the only option, certainly, though, and such rollovers are not always the best move. But believe it or not, as you see here, there could be as many as 6 different options for your employer-sponsored retirement plan funds when you leave work. And you can see, as we look at them here, some of them have benefits, some of them have drawbacks. So usually a good idea to discuss this with either, you know, a knowledgeable professional so that you can certainly make a decision that's right for you and your family. But as we look at these, you could leave the assets in that account. You could roll those over into a new company retirement plan. You could roll them into an IRA or take distributions or convert some of those, as you see on the right side of the screen. So getting money into your retirement accounts, that's really only the first half of the story. You know, coming up with an efficient way of taking those funds out and avoiding costly mistakes, that's the other half. And this is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income rates, just like interest. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in. So if your overall income is relatively low, you might have a low tax rate for your withdrawal. On the other hand, if your overall income is high, your tax rate will be higher and more of your IRA withdrawal will end up to good old Uncle Sam's hands. So here's a quick look at the tax brackets as we see for single and joint filers. And this is, you know, for the year 2021. And there you see all the brackets. But let's take a look at historically how those income tax rates have kind of fared. Because one of the troubling aspects of IRA planning is the tax rates on your future distributions. What are tax rates going to be in the future? They're unknown. Even if you can project your income with kind of relative degree of confidence, there's still no guarantee that tax rates are going to remain the same. And while it's hard to find someone who doesn't think they pay too much in taxes now, the reality is that the top tax rates today, when we look at this historically, are pretty low. This chart kind of spells that out. Take a look at when the income tax was first introduced in 1913, the top tax rate, very top rate, was only 7%. But within just a few years, it skyrocketed to over 70%. And after it dropped back down, kind of as low as 25% after World War I, the top rate then jumped again and jumped some more, you know, to 63% in 1932. From there, it wasn't until more than 50 years had passed, back in 1987, that the top tax rate finally dropped below 50%, letting those in the top bracket actually keep more of their income than they were forced to give to Uncle Sam. So now, of course, not everyone pays the top rate. In fact, it's only a very small percentage of taxpayers that actually do pay the top rate. But that said, with our national debt at all-time highs, a budget that hasn't been balanced in many years, fiscal troubles and packages and all that, and many of our entitlement programs, like you hear about Social Security and Medicare, you know, having issues, it's possible that tax rates could go up across the board. Certainly that's being looked at. And that makes coming up with the right plan even more important. So to make matters worse, your IRA withdrawals can cost you in a lot of ways more than just adding to your income. They can also cause you to be phased out of itemized deduction, personalized, personal exemptions, and various tax credits. They can increase your exposure to a surtax, the 3.8 surtax on investment income. If you take an IRA withdrawal, you might have to include more of your Social Security benefits in income, and your Part B Medicare premiums, those means tested, that those premiums could increase for sure. And that's just the beginning. So if you want to try to avoid all those issues, then need a plan. One way to minimize the tax impact of retirement account withdrawals is to avoid taking withdrawals altogether. if I don't take them, don't have to pay taxes on it, right? Well, that allows your retirement money to kind of grow tax deferred and keeps that nasty taxable income off your tax return for as long as possible. But you can't put off taking withdrawals forever, because we get to a point where we have to take what's called RMDs. Once you turn 72, the law requires that you begin to take required minimum distribution. We call them RMDs for short, from your traditional IRA. The same rules, by the way, generally apply to employer sponsored retirement plans like your 401ks. RMDs are simply the bare minimum that you are required to take from the account each year to satisfy the tax code's rules. Now, something about RMDs at 72 sounds a little weird to you. Don't worry, kind of sounds weird to me too. That's because RMDs generally begun once you reach 70 and a half, but that was changed. This is another one of the changes that was made right at the end of 2019 with the Secure Act. And in fact, there's actually discussions being thrown around now to even increase the RMD age. We'll see, but for now it stands at 72 thanks to the Secure Act. And a final thought before we move on from that, remember, you can always take more than the RMD, but if you fail to take the minimum amount, the IRS can actually hit you with a 50%, 50, that's right, 50% penalty for any amount that you should have taken but didn't. So pretty important to take those RMDs. So to calculate your RMD, you need to know a couple of things: your prior year-end balance and what's called your life expectancy factor. Getting your prior end year balance is usually pretty simple. In a lot of cases, you can look at your December or your fourth quarter statement, just use the ending balance. Then you use your age to look up the life expectancy factor on a special table provided by the IRS, and then divide your prior year-end balance by that factor. So here you see the table, and we'll give you an example. Suppose you're calculating your 2021 RMD. The first thing you need to know is your prior year-end balance. So imagine that December 31st, 2020, end of last year, your IRA balance was 200 grand, excuse, 200 grand. That's part one. So 200,000. Next, you've got to figure out your life expectancy factor. So most of the IRA owners use what's called the Uniform Lifetime Table to calculate their RMDs. If you look on the screen, giving you some of the life expectancy factors here. So imagine you turn 75 this year. Now we simply go to the table and look up the factor for a 75-year-old, and you see it's 22.9. So that's going to determine the RMD in this hypothetical example. We're going to divide 200,000 by 22.9, and we come up with $8,733.63. Now, each successive year, you do the same thing. You take the prior year-end balance, divide it by your new life expectancy factor. You just continually go down the chart. Not too bad, right? All right. Well, most people don't think about things in terms of factors or life expectancy. So this chart, I think you might find a little more helpful. It shows the approximate percentage. So we've taken that factor and turned it into a percentage of what you need to take out of your IRA, starting from age 72 all the way up to 91, in order to steer clear of that penalty. So if you look, you'll see each year that percentage gradually increases. Now, that doesn't necessarily mean you need to take more money out each year, maybe more money out than you did last year, as that also depends on that first factor, like IRA value, and there could be gains the year or losses from year to year, but the percentage does increase every year. So RMDs can actually get much more complicated, and as we've already discussed, the penalties for making a mistake here is pretty severe. So with that in mind, we're going to tell you about 3 of the most common RMD mistakes people make so that you can avoid them. Remember, part of any IRA planning is minimizing costly mistakes. So One common RMD mistake people make is incorrectly aggregating their RMDs between different types of retirement accounts. So for example, suppose you have a 401k and you have an IRA, and after calculating your RMDs from each of those accounts, they come out to be $4,000 and $3,000 respectively. So you add those up for a total of $7,000. Now imagine your IRA is earning a higher rate of return than your 401k. Well, you might be tempted just to pull the $7,000 out from your 401k and leave your IRA alone and call it a day. After all, what's the difference, right? They're both retirement accounts. And whether you take $7,000 from just your 401k or $4,000 from your 401k, $3,000 from your IRA, it is the same impact on your tax return. And that's pretty logical thinking. But the tax rules are anything but logical, and they specifically prohibit you from doing that. An RMD for one type of retirement account, like an IRA, can never be taken from another type of retirement account, like a 401k. So by the way, if you did have two IRAs, that's the same type, so you could combine it there, but you can't combine the different types. Another common RMD mistake is aggregating RMDs between spouses. So let's take, suppose you and your spouse file a joint tax return. You have an RMD for your IRA of $4,000. Your spouse has an RMD for their IRA of $2,000. So to make things easy, you simply take $6,000 out of your IRA. After all, they're both IRAs, and since you file jointly, the income is going to show up on the same return, right? While that may be true, it doesn't matter. Retirement accounts are individual accounts. So there's no such thing as a joint IRA or a joint 401k. So you must always take your own RMDs from your own accounts. And then the third common RMD mistake is forgetting to take the RMD at all. And although this should never happen, sometimes mistakes are made. It's just a fact of life sometimes. Maybe a family member was sick and you got preoccupied. Maybe you were away on, let's say, your dream vacation. It simply slipped your mind, and then the year end came and you forgot. Whatever the reason, if you forgot to take an RMD or if you otherwise made a mistake, the one thing you should not do is forget about it and pretend that it never happened. In most cases, if you do that, the IRS can come back and assess 50% penalty along with a host of other penalties and interest indefinitely. So avoid that. So one strategy to minimize the impact of taxes on your retirement savings is to avoid taking distributions from your IRA for as long as possible. This allows your retirement money to enjoy that favorable tax deferred status for as long as possible. It also helps to keep income off of your return, which, as we've already learned, not only helps you lower your income tax bill, make it lower, but can also prevent increases in those other costs that are tied to your income. Now, there are major downsides to this approach. Most notably is that as your IRA gets bigger, so does your problem. Think about it. If your tax bracket remains about the same over time, then as your IRA grows, so does the amount you're eventually going to have to take to pay Uncle Sam. And so this is much different from the other things you may be used to. For instance, imagine you buy a house for $200,000 and have a $50,000 mortgage. If the house doubles in value to $400,000, does the mortgage increase to $100,000? No, of course not. So you get to reap all the benefits of that appreciation. But that's not the way it works with an IRA or 401k or a similar account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is entitled to his share. Plus, by waiting to take distributions as long as possible, your required minimum distributions, your RMDs later on, they're going to be larger. So this could increase that impact, some of those side effects we've talked about already. Thankfully, there's a way to fix that so that, to go back to the mortgage analogy for a moment, you can own your IRA free and clear, so that only you benefit from the future appreciation. It's called a Roth IRA conversion, And that's a strategy we're going to discuss for a little bit coming up. So Roth IRA conversion is the name given to a special type of transaction where you move money from your pre-tax retirement account, like an IRA or 401k, over to a Roth IRA. When you make a Roth conversion, the amount of money you convert is added to your tax return for the year and is taxable at whatever income bracket you happen to be in. So an example here, you see it, Jill has $100,000 from her IRA. She wants to convert it to a Roth IRA. We'll talk about why she might want to do that in a moment. But if Jill moves forward with her $100,000 Roth IRA conversion, she'll have to add $100,000 of her income to her tax return for the year, which will be taxable at whatever rate Jill happens to be at. Because this is a big decision and can have pretty big impact on your taxes, it's always certainly best to discuss this option with your tax advisors or your financial advisors beforehand. Certainly want to think this out. So why would you voluntarily choose to make one of these Roth IRA conversions and pay taxes before you have to? Well, there are a lot of reasons, but perhaps the most common one is we've already discussed, and that is to pay Uncle Sam now so that you own your retirement account free and clear for life. So remember, with a Roth IRA, you have the potential for future tax-free withdrawals of everything in your account. If you're over 59 and a half, and if you've had any Roth IRA for more than 5 years, then all the withdrawals from any of your Roth IRAs will be tax and penalty free for life. If you're over 59 and a half, but haven't had a Roth IRA for 5 years yet, you can actually still take out any of your converted amount tax and penalty free at any time. And if you're younger than 59 and a half, other rules are going to apply. So something else to keep in mind is that unlike Roth IRA contributions, there are no restrictions on who can make Roth IRA conversions. You can't be too old, you can't be too young, you can be working, or you can be retired. There's no minimum amount of income you need or maximum amount of income that you can have. And I think you see what I mean. It's kind of wide open. If you want to convert a traditional IRA to a Roth IRA, there's nothing in the tax rules that will stop you from doing so. But does that mean it's right for you? Well, the potential tax-free nature of the Roth IRA may also provide you with these additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are lots of unknowns there, of course. What will the market do? What's inflation going to look like? What will your tax rate be? And so on. And so that last one, taxes, is a major concern for many retirees, and one we've already talked about a bit. A Roth IRA conversion could help manage that risk by paying taxes at today's known rates. If taxes rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate is going to be lower in retirement, then that would be an indication that maybe this is not the right strategy for you. And oftentimes we do see folks retire into a lower tax bracket. So keep that in mind. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact those other things tied to your income that we discussed earlier. So another big benefit of the Roth IRA, and one many retirees find attractive, is that Roth IRAs have no required minimum distributions during your lifetime. So remember all those RMD calculations and potential mistakes we talked about earlier? They're not an issue if you have a Roth IRA. During your lifetime, you can take as much or as little as you want. You're not forced to take anything at age 72 if you don't want to. So that means your Roth IRA can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle for an estate planning perspective, for sure. Now, the Tax Cuts and Job Act, however, did eliminate the recharacterization option for conversions made in 2018 and later. So if you convert your Roth IRA now or in the future, you're stuck with that decision. You can't go back on it. Even if your tax bill is higher than you thought, or if the conversion accidentally phased you out of a credit, or if your investments dropped in value, no matter what the reason, you can't recharacterize that conversion. So with that in mind, it's very important that you are sure you want to convert a Roth IRA before you do it. And here are the three questions really you have to ask yourself before converting. Do you have a rough idea of the conversion's conversion's impact on your tax bill? So do you have a rough idea of the conversion's impact on your tax bill? Do you have a plan to pay the resulting taxes? Do you have a reasonable expectation that the benefits of prepaying your taxes like this actually makes sense in your overall plan? And so really, to go forward with something like this, the answer to all these questions should be yes. If you come up with a no in there, it's probably a good reason not to do it. Here's another conversion strategy might be helpful. It's called filling the bucket up, or filling up the bucket strategy. Remember those tax brackets we looked at earlier? Well, sometimes you can find yourself kind of in the middle of one of them with more room to add more income before you push yourself into one of the higher brackets. So for example, in 2021, the 22% tax bracket for married couples filing jointly, that goes from about 81,000 up to 172,000. So suppose then you file a joint return and your taxable income is at 100,000. That means you could actually add another 72,000 of income before you trip over into the next bracket. So that might, making a Roth conversion, a Roth IRA conversion out of the remaining amount that you have left in that bucket, that might make sense. But if you plan to convert a sizable portion of your IRA, this approach is often, more tax efficient than converting the full amount at one time, just doing part of it. Instead, you can make a smaller Roth IRA conversion, over numbers of years, kind of filling up the buckets without spilling over into the next one, if you will. So this can help you reduce the average tax rate you'll pay on the converted money, and also kind of spreads that tax bill over certainly a longer period of time. So that's kind of one strategy to think about. Roth IRA conversions could be especially useful if you've had a low income year. For example, if you're a business owner with unusually low sales, or are you paying high or non-recurring medical bills, or maybe you retire but not yet receiving Social Security benefits or pensions or IRA distributions. Those are questions to ask to see if a Roth conversion might be a good move for you. So, of course, these strategies aren't for everyone, as I mentioned, and certainly, as you can see here, there's no guarantee that a Roth conversion will achieve the intended results. There's a good chance that at some point in your life, you're going to want to move around some of your money. Let's take a look at some of that stuff in our next strategy. Maybe it'll be done as part of a Roth conversion. Maybe it'll be to make a new investment, or maybe to work with a new advisor. But for whatever reason, you should be aware when you're moving retirement money around, there are things to consider so you don't make costly mistakes that could kind of derail you. So in general, there are two ways you can move retirement money. You can either move it indirectly in what is known as a 60-day rollover, or you can move it directly via a direct rollover or a trustee-to-trustee transfer. So moving money directly is usually the savvy choice. So let's first talk about indirect rollovers. An indirect rollover, you receive the distribution of your retirement funds payable to you. They're even actually sent to a non-retirement account. They might be sent to a checking account or something like that. Then you have 60 days from the time that you receive your distribution to get it back into another retirement account. If you miss the 60-day deadline, the distribution is taxable, and depending on your age, it may be subject to an additional 10% penalty. Even if you're on top of things and you complete your rollover within 60 days, there are other problems with indirect rollovers. For instance, If your withdrawal is coming from an employer-sponsored retirement plan like 401ks, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure you don't take your retirement money, run away, and never pay taxes that you owe. A separate kind of troublesome rule applies to 60-day rollovers from IRAs. If you're moving your money to another IRA, let's say, only one of those rollovers can be done per year. If you try and make a second 60-day rollover, chances are the entire amount will be taxable. And the same rule applies to Roth IRA rollovers. So, as you can see, there are some real problems with indirect rollovers. Thankfully, there's a better way to move your retirement money. In a direct rollover, a trustee to trustee transfer, your money is sent right from your old retirement account to your new retirement account. There's no 60-day time limit to worry about. There's no mandatory 20% withholding. And there are no one rollover per year rules to be concerned about. That's the direct rollover. And typically this is done by providing you with a check made payable to your new custodian. For example, the check might read, Company X, custodian, for benefit of FBO, John Smith, IRA. If your check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There's no 60-day deadline, no mandatory withholding. That's true even if your plan sends you the check and has you then forward it to the new custodian. As long as it's made out properly, that will be good. Another essential component of any savvy IRA planning is to make sure that you coordinate your IRA planning with your overall retirement, estate, tax, education, and financial plans. Your IRA and other retirement accounts can impact each of these areas, so it's important to factor those things into your planning. And some of you may have all of your savings in retirement accounts, but many of you probably have some of your savings in IRAs, 401ks, and the like, with other savings in non-retirement accounts. If that's the case, one strategy you may want to consider is coordinating your IRA with your overall plan and carefully selecting which of your investments are purchased with IRA money and which investments purchased with non-retirement account money. Doing so could actually help lower your tax bill. And let's take a look at this. Here's an example. So imagine you have $100,000 in an IRA and $100,000 in a non-IRA account. Let's assume hypothetically that you want to purchase $100,000 of bond with a hypothetical interest rate of 4% and $100,000 of stocks that will pay qualified dividends of 4%. Now, assume that you plan to live off the income that these investments generate and that you are in the 24% tax bracket as we see here. So how's that going to look? Well, the first scenario, the one on the left side here, or kind of in the middle, you see all the stocks are purchased inside the IRA and they generate $4,000 of qualified dividends. Now, in general, qualified dividends receive special tax treatment and they're taxed at long-term capital gains rates. These rates happen to be lower than ordinary income taxes. However, this investment was all made inside that IRA wrapper, and withdrawals from an IRA are taxed at ordinary income tax rates. So if you take a withdrawal of the $4,000 of the qualified dividends, they're still going to be taxed at your 24% ordinary rate we talked about. So that will result in a $960 tax bill as we go down the column there. Same scenario on the right side. All right, you have $100,000 of bonds generating $4,000. That bond interest is taxed as ordinary income too in the non-retirement account. So you're going to owe $960 tax on that as well. So you look at the total, $1,920 in the middle. Now let's look at a slightly different scenario. The second scenario, we're purchasing the bonds inside the IRA. They generate that same $4,000 interest as before. If withdrawn from an IRA, you're taxed at the 24% rate, giving you $960 tax bill that you had kind of like you had before. But on the right-hand side, you're now purchasing stocks with non-IRA money, and your qualified dividends are taxed at long-term capital gains rates. So if your ordinary income tax bracket is 24%, and you have, by the way, you would have a 15% rate on your long-term capital gains. Now your tax bill on your qualified dividends drops to $600, bringing your total tax bill to $1,560. So that's $360 in this scenario, compared to where, you know, you were at $1,900 something in the prior scenario. In both scenarios, remember, you invested the exact same amount of money in the exact same investments, and you took the exact same risk. But scenario number two, you got to spend an extra $360 simply because of that planning. So remember, when it comes to your investments, it's not just what you own, but kind of where you own it. Of course, you should be aware that anytime you're dealing with investments, there's no guarantee they're going to perform as expected. And, you know, while we don't anticipate the special tax rate for long-term capital gains to be eliminated, again, a lot of talk out there. Don't have a crystal ball to predict what Congress is going to do in the future, but certainly there's a lot of things on the table, right? All right, so now we're talking about coordinating IRA planning with Social Security, and this is just another way that planning kind of needs to be coordinated, especially when you consider your claiming strategy. So the decision of when to file for Social Security is one that, you know, far too many retirees make without thoroughly evaluating their options first. This is a major mistake, and one that in some cases, if you think about lifetime income, can cost you over $100,000 if you happen to retire. And then, you know, as we mentioned, the life expectancies last until 90 and 95, you know. So now the decision of when to claim Social Security, those are personal decisions, and certainly one that varies pretty significantly between person to person and couple to couple. But that said, many retirement experts today believe that too many people claim Social Security too soon. So remember, Social Security benefits are guaranteed to last your entire lifetime, no matter how long you live. Once you turn it on, the benefits then are increased, you know, from year to year through the cost of living adjustments. Additionally, delaying receiving Social Security benefits past what's called your full retirement age, which is 66 or 67 or somewhere in between for most of us, that can allow you, by delaying, it can actually allow you to earn an additional 8% increase in the payments each year until you turn 70 through what's known as deferred credits. So for these reasons and more, it may be more beneficial to claim Social Security benefits later than you might have initially planned for. But you have to eat, right? In the meantime, life is going on. That might require you to pull money from your IRA in the interim to help you cover your current living expenses. So retirees sometimes opt not to do that strategy because they say, well, what if I die early? I've spent my IRA money, which takes away from my heirs, and I've got little or nothing, you know, to show for it. Well, that's certainly something to consider. And here are a couple of reasons why you might, you know, give that approach a second thought. First is a 2012 report from the Center of Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not the cheapest, annuity available. That might sound a little funny, right? But after all, you don't think of us buying Social Security, but in a way, we kind of do, right? We paid into it. If you use IRA money to hold off on your claiming Social Security for, say, a year, that's kind of the price you paid to get a higher benefit. So there is a cost there. So you do pay for it in a way. If you compare that price and increase benefit to what you can get from, you know, commercial annuity providers, it's almost always cheaper. Another reason it can make sense to draw from your IRA in order to help you to delay claiming Social Security benefits is that those Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you take an IRA withdrawal, the entire amount is generally added to your income and you're taxed at whatever rate you happen to be at. In contrast, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point here is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. So think about that. All right, time to move on to our next IRA planning strategy, and that's coordinating your IRA planning with your estate plan. In most estate plans, there are really two primary goals. The first is to make sure that your assets pass on to your intended beneficiaries, and then secondly, that they are passed to them as efficiently as possible. So when it comes to IRAs, 401ks, and other retirement accounts, that's done with one form in particular, the Beneficiary Form. And I really, can't emphasize how important this form is. And yet, from time to time, people fail to update those forms after major life events. Think of births, deaths, marriages, divorces, all those things happen. But many times people think that because they've updated their will, if they have a will, everything is taken care of, but that's not so. So, for example, if you have your ex-wife or ex-husband named on your IRA beneficiary form, but you updated your will to say all your assets are going to go to your children upon your death, guess who's getting your IRA? That's right, it's going to be your ex-spouse, because that beneficiary form takes precedence. And folks, this does happen, and we see it more frequently than we should. So that's why it's important to keep updated copies of your beneficiary forms with all your other important estate planning documents, and obviously review those from time to time. So now that you understand the importance of the beneficiary form, we're going to talk about a little bit more about IRA beneficiaries. So any person or entity can be an IRA beneficiary, but there are different post-death withdrawal rules depending on the type of beneficiary that you select. So broadly speaking, there are three main types of IRA beneficiaries after the Secure Act was passed. There are non-designated beneficiaries, designated beneficiaries, and what's called eligible designated beneficiaries. As you can probably guess by looking at this slide here, the non-designated beneficiaries, they generally have the worst tax treatment. Those are the ones on the right hand of the screen. Eligible designated beneficiaries generally have the most favorable tax treatment. You might be thinking to yourself, well, shouldn't I just make all of my beneficiaries eligible designated beneficiaries then? Well, unfortunately, in many cases, that may not be possible, at least if you want to make sure that specific people get your life savings. So for instance, take a look at the different types of eligible designated beneficiaries there. Certainly no one is going to hope that their beneficiaries are disabled or chronically ill. And if you don't have minor children now, it's highly unlikely that you're going to have one in the future. The trusts you see here are generally only trusts where the only beneficiary is another type of eligible designated beneficiary, such as a disabled person. So that doesn't really work, which leaves you with beneficiaries who are not more than 10 years younger than you are, which generally won't apply unless you're leaving your IRA to siblings or friends, and then spouses. If you're married, chances are that your spouse is your beneficiary. But when that second death occurs, who's going to collect the retirement funds to be left to? Well, in many cases, it's going to fall to adult children who fall into that middle green category, the non-eligible designated beneficiaries. So let's take a closer look at the rules for post-death distributions for each of these categories. And we're going to start with the group of beneficiaries that generally has the most unfavorable treatment, the non-designated beneficiaries. So this is the group that's comprised of beneficiaries that really have no life expectancy and includes things such as estates and charities. And as you see, the rules for how quickly money must be distributed from the inherited account after death depend on how old the owner of the account was when they died. So prior to required beginning date, there's the 5-year rule. On or after, well, it's the remaining life expectancy. In many cases, that means these beneficiaries must distribute the entire inherited account within 5 years, and that can lead to big lumps of income that get taxed at higher rates than the owner may have paid during their lifetime. Next, we have the designated beneficiaries. So if you've named children, grandchildren, nieces, nephews, or other similarly close family members who are not your spouses, your IRA beneficiary, there's a good chance that they're going to fall into this category. So in the past, this group of beneficiaries was able to take advantage of something known as the stretch, which is where those distributions from the inherited account would be spread over the individual's life expectancy. This allowed for tax benefits of the retirement account to last for as long as possible and kept the taxable income each year to a minimum. Unfortunately, the good old Secure Act, yes, that same one from 2019 we talked about, it eliminated that tax benefit for regular designated beneficiaries. Now, instead, this group of beneficiaries has to distribute all the entire, well, basically an entire inherited IRA by the end of the 10th year after they inherit. So this is a 10-year rule. This new 10-year rule isn't as bad as the 5-year rule that hit some of the non-designated beneficiaries, but it's a far cry from the decades that some grandchildren and children, they had to spread out those distributions before the Secure Act was enacted. So those of you who expect to pass on a large retirement accounts to heirs should be particularly mindful of this change, as it might influence planning decisions during your lifetime, such as how much, if anything, to convert to Roth IRAs. The new 10-year rule, effective for most IRA beneficiaries and plan beneficiaries, began, by the way, in 2020. There are certain exceptions, including like some governmental plans, some collective bargain plans, and certain annuities where lifetime income options were available. So finally, we get to the brand new type of beneficiary created by the Secure Act. I'm going to take a quick swig. These are called eligible designated beneficiaries. And they are the only ones left who, wait for it, are eligible for the stretch distributions using the rules that were in place before the Secure Act was passed. So you see spouses, disabled persons, chronically ill, individuals within 10 years of the decedent's age, or IRA owners' minor children. So as we discussed before, pretty limited list, and doesn't help with many of you who plan to eventually leave your retirement assets to your adult children or other persons who don't fall into any of these categories. And this is what it means to stretch the IRA distribution. So eligible designated beneficiaries, and only eligible designated beneficiaries, are able to take minimum distributions calculated over their IRS provided life expectancies. The stretch IRA then is just kind of the name practitioners have given the strategy of a beneficiary taking only the minimum amount of an inherited IRA each year that's required by law. Doing so helps the eligible designated beneficiary to certainly minimize their income tax and maximize that tax deferral of the inherited account. In contrast, all the other beneficiary types have to withdraw all inherited IRA money much sooner, as we talked about. So one question many folks ask is whether or not they should leave their IRAs to a trust. So trusts are certainly good at providing post-death control, and if that's a major concern for you, it's certainly something to consider. However, naming a trust as your IRA beneficiary adds considerable complexity to your estate plan. So if drafted properly, trusts can be treated as designated beneficiaries and preserve that stretch IRA. But all too often, they really don't meet the specific requirements that are outlined by the IRS, and they end up having to follow less favorable rules for non-designated beneficiaries. So even if drafted properly, trusts come with certain costs, and so you got to have a cost to prepare the trust itself, the cost of filing annual trust income tax returns, and certainly the accelerated taxation of any IRA withdrawals that are held inside of that trust. So ultimately, naming a trust as your IRA beneficiary is kind of a complicated matter, and is something that certainly should be considered and discussed with kind of your full team of advisors, your tax folks, your estate planning attorney, and your financial advisor. So many people name their spouse as a beneficiary on their IRA. So let's talk about that for a moment. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA. They include choosing to remain as the beneficiary of the account, as well as making what is known as a spousal rollover. So let's talk about each of those in a little more detail. So just as I just mentioned, one option is that spousal beneficiary has, in completing a spousal rollover. A spousal rollover, in doing that, the surviving spouse takes the deceased spouse's IRA and moves it right into their own IRA. A spousal IRA rollover is irrevocable. So that decision, once it's completed, can't go back. The funds are treated as though they were always the surviving spouse's IRA. And this is generally the best option for spouses who inherit at 59 and a half or older. Another option available is to spouse beneficiaries is remaining as the beneficiary of the inherited account. This is generally the preferred option if a spouse inherits prior to turning 59 and a half, because it allows them to take penalty-free distributions from an inherited account regardless of their age. So in contrast, if they were to make a spousal rollover, the money would be treated as their own, and therefore any distributions prior to 59 and a half would be assessed a 10% early distribution penalty. If you're a spouse beneficiary and you inherit prior to reaching 59 and a half, you can remain a beneficiary until you turn 59 and a half, and then at that time, do the spousal rollover. In fact, more often than not, that is the best approach if you're in that situation. So there are other special rules that do apply to spousal IRA beneficiaries. So it's always best, again, to talk to your professionals, see what's best for you. All right. And then finally, we're going to wrap it up kind of with this, is that watch out for scams, right? That's our last strategy. And it's one everybody should know by now, but sometimes we just forget. And so it's always good to do your homework before making any decisions with your IRA, especially when it comes to investments. IRAs are often the target of schemes and scams because, let's face it, that's where a lot of people's savings are. And I know it, but you know who else knows it? The scammers. They know it. In recent years, the SEC has issued alerts warning certain IRA owners that they may be the target of scams. And the IRS has even put out a publication with the title, "The IRS does not approve IRA investments." And that was in response to many fraudulent promoters claiming that their IRA investments were somehow given the green light by the IRS. But at the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Now, your IRA likely to represent a lifetime's worth of work and savings, and we certainly wouldn't want anyone to squander it away by making, foolish decisions or being scammed out of it. So we've covered a lot of ground today, and should give you plenty of food for thought. And you probably realized at this point, IRA planning is a little more complicated than most people realize, but let's face it, deciding what strategies are best for you crosses into just about every area of planning, tax planning, investment planning, estate planning. Few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to truly evaluate all the issues and kind of develop a comprehensive solution there. So hopefully we've helped answer, maybe some of the questions, especially the ones we talked about at the beginning. but chances are, you may have others, and that's okay. We're here to help with any questions you might have, help evaluate your financial picture, and, see what's best for you and your family. So that's going to wrap it up. We appreciate you joining us. As a helpful guide, by the way, we have a 6-page IRA guide available, and that summarizes a lot of what we talked about here. And we can certainly mail you one if you wish. If you'd like to do that, just send your address to the email you see on the screen, info@horizonfg.com. But guess what? We also have a PDF version available in the chat section right now. So if you go to the chat on the webinar right now, you could see the PDF there, and you can download that if you'd like. But we would love to mail one out to you if you'd like. It summarizes, again, everything we kind of talked about, the main points. So to do that, send us an email, info@horizonfg.com. Or if you have any other questions, please let us know. If you need to schedule a visit with one of our Horizon advisors, email us at this address as well. Well, that's going to wrap it up for today's session. We're going to leave the meeting up just for a few more minutes for anyone that kind of wishes to access the PDF that we talked about. But certainly we hope to see you soon. Thanks for joining us. We'll have some more webinars down the line, so join us then. But bye for now. See you later.